All right, stop scrolling for a second because something big just happened in silver and it happened fast. We watched silver collapse from roughly $121 down to about 71 in a matter of days, and now, right now, it's snapping back toward $90 an ounce in the West, up nearly 12% in a single session on February 3rd. That's not a normal bounce, that's a snapback. And here's the kicker. Shanghai barely blinked, holding closer to 95 to 100 the entire time. Both Western spot pricing and Asian physical markets just confirmed the same thing at the same time. The real trigger wasn't demand collapsing, it was margin chaos. Stay with me because I'm going to show you exactly how this happens, how to spot it next time, and why this move could change everything if you're paying attention. If you're holding silver right now, if you've been stacking, if you've been watching this market wondering what the hell just happened, you're ahead of 99% of people who think they understand commodities. Your job is to understand the mechanism, not just react to the price. Before I explain what caused this, let me teach you something most people never really internalize about commodity markets. Price doesn't just reflect supply and demand, it reflects who's forced to act right now. Think of the paper market like a crowded theater with narrow exits. When everyone's calm, prices drift slowly. They move on fundamentals, on expectations, on gradual shifts in sentiment. But when leverage builds and someone yells fire, margin hikes, volatility spikes, people don't walk out calmly. They stampede. That's what you just saw. That's what 99% of people miss when they look at charts. They see price collapse and they assume fundamentals broke. They assume demand disappeared. They assume the bull market's over, but sometimes nothing broke at all. Sometimes the structure did. Sometimes the plumbing of the market seized up and forced actions that had nothing to do with whether silver's worth $70 or $120 long term. And if you don't understand that difference, if you can't spot the difference between structural selling and fundamental selling, you end up selling right when the pressure's about to release. You panic at exactly the wrong moment. You become the exit liquidity. So, what does that tell us? It tells us that not all crashes are created equal. Some crashes are warnings, some are opportunities, and the only way to know which is to understand what's driving the move under the hood. Now, here's what's actually happening, step by step. Silver had become heavily leveraged, especially on Western exchanges tied to futures contracts. Traders weren't just buying silver, they were buying silver with borrowed money, with margin, amplifying their exposure. When volatility surged, and it surged hard over the past couple weeks, the CME raised margin requirements. That sounds boring, I know. It sounds like technical jargon that doesn't matter, but it's everything. Higher margins mean traders suddenly need more cash just to keep their positions open. If they don't have it, if they can't post more collateral, they're forced to sell. Not because they want to, not because they think silver's going to zero, because they have to, because the exchange says you need more money or we're closing your position. So prices start falling. And when prices fall, that triggers more margin calls for other traders, which forces more selling, which pushes prices lower, which triggers even more margin calls. That's the cascade. That's the death spiral. That's how you go from $121 to $71 in days without physical demand disappearing, without industrial users saying we don't need silver anymore, without jewelry demand collapsing. The fundamentals didn't change. The structure broke. Here's what's wild though. While paper silver was imploding on COMEX, while futures traders were getting liquidated left and right, physical silver in Shanghai held near $95 to $100. Let that sink in for a second. The same metal priced 50% higher in Asia than it was trading in the West at the lows. That divergence is the tell. That's your smoking gun. It means real metal wasn't flooding the market. It means people who actually hold physical silver, who can touch it, who have it in vaults, weren't panicking. They weren't selling. The selling pressure was mechanical. It was forced. It was paper contracts getting unwound because traders couldn't meet margin calls. Then, once the weakest hands were flushed out, once margins stabilized, once the forced selling stopped, something predictable happened. Shorts started covering. Traders who had bet against silver, who sold it short expecting it to keep falling, they started buying back their positions. And when you have a thin market, when liquidity's already been drained by the crash, that buying doesn't just move price up gradually, it snaps violently. You get 12% moves in a single session. You get price rocketing from 71 back toward 90 in hours, not weeks. But here's the part that should make you nervous if you're not watching closely. When paper prices have to realign upward with physical markets, when the West has to catch up to Shanghai, the move can overshoot fast. Because you're not just recovering from forced selling, you're also dealing with short covering, with FOMO buying, with people who sold at 80 rushing back in at 90. The mechanics that drove it down create equal and opposite pressure on the way back up. This isn't speculation. This isn't me guessing. This is observable, repeatable market behavior. And if you know what to look for, you can see it coming. Now, let me show you what very few people are talking about. The divergence between paper and physical didn't just happen randomly. It happened because Western exchanges are primarily derivatives markets. They're places where people trade contracts representing silver, not actual silver. Shanghai, on the other hand, has much tighter integration with physical delivery. When you buy silver in Shanghai, there's a much higher probability that metal's actually changing hands. So when margin pressure hit COMEX, when futures positions got liquidated, that didn't affect physical silver sitting in Chinese vaults. Those holders didn't get margin calls. They didn't need to liquidate. They just held. And by holding near $100 while paper dropped to 71, they sent a clear signal. The physical market wasn't validating the crash. The physical market was saying, this is nonsense. This is temporary. This is structure, not substance. And when paper and physical diverge like that, when the gap gets that wide, it doesn't last. Either physical comes down to meet paper, which would require actual fundamental deterioration, or paper snaps back up to meet physical, which is what we're seeing right now. This isn't speculation. It's the exact same playbook we saw in 2011. Silver had run from $18 to nearly $50 in the first 4 months of the year. Everyone was euphoric. Then in May, the CME raised margin requirements 5 times in 8 days. 5 times. And silver collapsed from $48 down to $32 in a matter of days. Everyone declared the bull market dead. The silver bugs were wrong. It was all manipulation. It was over. And then it rebounded aggressively. Within weeks, silver was back above $40. Why? Because the forced liquidation ended. Because once the leveraged specs were flushed out, once margin requirements stabilized, the actual buyers of physical silver stepped back in. The fundamentals hadn't changed. The structure had just been reset. Same pattern. Margin hikes, forced selling, price collapse, physical demand holds, snapback. We saw it again in March 2020, remember that? COVID panic, liquidity vanished everywhere, and not just in silver, everywhere, but silver got hit particularly hard, dropping from $18 to $12 in a matter of days. People said the bull market was over before it started. And what happened? Silver launched from $12 to $30 over the next 5 months. Every time this happens, the pattern rhymes. Leverage builds, someone raises margins, or liquidity dries up. Forced selling breaks price way below where physical markets are clearing, and then price snaps back harder than people expect. It's not magic, it's mechanics. And if you're not looking for the divergence between paper and physical, if you're not watching for forced liquidation versus fundamental selling, you're going to get whipsawed every single time. Here's another example. September 2011, right after that May crash. Silver dropped again from $43 to $26. Same thing. Margin pressure, leveraged longs getting squeezed, forced selling. Physical buyers in Asia didn't panic. They accumulated. And silver rebounded back above 35 within weeks. Zoom out, and you see the larger story isn't volatility. The larger story is resilience. The market isn't rejecting higher prices. It's clearing excess leverage so it can attempt them again. Every violent shakeout is the market saying we had too many weak hands, too much borrowed money, too many people who can't handle the swings. Let's flush them out and try again with stronger hands. That's what's happening right now. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be a dead cat bounce? Absolutely. Could broader risk markets roll over? Could stocks crash? Could recession fears intensify and drag everything down again? Yes, that's possible. And no, this doesn't mean silver only goes up from here. Markets don't move in straight lines. We could absolutely see silver test $80 again, or even 75. I'm not here to tell you it's a straight shot to 150. That would be irresponsible. Could this be manipulation by big banks or governments trying to suppress prices? Maybe. I don't know. You don't know. And here's the thing, it doesn't actually matter whether there's manipulation or not. The mechanics are what matter. Arguing about who's behind the curtain doesn't help you trade better, it doesn't help you invest better. Focus on what you can control, focus on what you can actually measure. Focus on spreads between paper and physical. Focus on margin requirements. Focus on volume and open interest. Focus on confirmation across markets. That's how you stay grounded when emotions are running high. That's how you avoid getting swept up in conspiracy theories or hopium or despair. You watch the data, you watch the structure, you make decisions based on observable reality, not narratives. There are probably three types of people watching this right now. The first type panicked during the crash. You sold silver at $80 or $75 or maybe even at 71 thinking it was going to 50. And now you're watching it race back toward 90 and you feel sick. You feel whiplash. You're angry at yourself. If that's you, breathe. Your lesson here isn't about catching tops or bottoms. Nobody catches tops and bottoms consistently. Your lesson is about recognizing forced liquidation so you don't confuse it with real demand destruction next time. When you see price collapse but physical markets hold firm, when you see paper and physical diverge massively, that's your signal that something structural is happening, not something fundamental. Learn to spot that. Learn to wait it out. Because if you sell into forced liquidation, you're selling to smart money who understands what's happening. Don't be the exit liquidity. Be the person who recognizes the pattern and either holds or even accumulates when everyone else is panicking. The second type of person watching this stayed on the sidelines. You've been interested in silver, maybe you own a little bit, but you didn't buy during the crash because you were scared. And now you think you missed it. Maybe you did, maybe you didn't. Here's the reality. Your job isn't to chase candles. Your job isn't to buy silver at $90 today just because it's up 12%. That's FOMO. That's how you get hurt. Your job is to wait for confirmation. Does silver hold the $85 to $90 zone? Does it reclaim 95 to 100? Does physical and paper stay aligned? Or do they diverge again? If silver consolidates here, if it builds a base between 85 and 95, if Shanghai and COMEX stay in sync, that's your confirmation that the structure's been reset. That's when you consider positioning. Not on a 12% up day. Not when emotions are running hot. When things calm down and the pattern confirms itself, be patient. Opportunities don't disappear, they just evolve. The third type of person watching this has been in silver for years. You've been stacking since $15 or $20 or $30. You rode it up to 121. You watched it crash to 71. And now you feel vindicated watching it bounce back. I get it. You weathered the storm. You didn't panic. That's commendable. But even conviction needs discipline. Even long-term holders need to respect invalidation levels. If silver breaks below 70 to 75 again, if we see another cascade that takes out those lows, something's changed. It doesn't mean you have to sell everything. It doesn't mean the long-term thesis is dead. But it means reassessment is required. It means the structure might be weaker than you thought. Don't let conviction turn into stubbornness. The market doesn't care what you believe. It only cares about supply, demand, and the mechanics of price discovery. The universal principle for all of you, regardless of where you are, is this. Understand the mechanism before you act. Don't react to price. React to the forces driving price. When you see forced selling, recognize it for what it is. When you see physical markets holding while paper collapses, understand what that divergence means. When you see snapbacks, understand they're not random. They're the market clearing out weak hands and reestablishing equilibrium. If you understand the mechanism, you make better decisions. If you just react to charts, you get whipsawed. So here's what I want you to answer in the comments. Did you buy during the crash? Did you sell? Are you waiting on the sidelines? And more importantly, what are you watching right now to confirm or invalidate this move? I want to hear your process, not your predictions. Your process. Because that's what separates people who survive these markets from people who get chewed up. So here's where I stand. I'm not euphoric, and I'm not bearish. I'm focused. Let me tell you what I'm personally watching. First, I'm watching whether silver holds the $85 to $90 zone. That's your launch pad or your failure point. If silver can consolidate here, if it can build support in the mid to upper 80s, that tells me the forced selling's done, and we're building a new base. If it fails, If we see another leg down below 80, that tells me there's more pain coming. Second, I'm watching Shanghai parity. 95 to 100 isn't just a number. It's confirmation that physical and paper are realigning. If COMEX catches up to Shanghai and they trade in sync, that's healthy. That's what you want to see. If they diverge again, if paper collapses while physical holds, we might see another round of this chaos. Third, I'm monitoring the 70 to 75 zone as invalidation. If we break below that, if we take out the recent lows, the entire structure changes. It means either fundamentals are deteriorating, or there's more forced selling to come, or both. I don't think that happens, but I'm watching for it. Because I could be wrong, the market doesn't care what I think. Based on my analysis, this crash was mechanical, not fundamental. It was structural, not driven by collapsing demand. Physical demand never cracked. Industrial users didn't stop buying. Jewelry demand didn't evaporate. Asian buyers didn't panic. What happened was leverage got too high, margins got raised, and weak hands got forced out. That's it. The fundamental picture for silver hasn't changed. We still have supply constraints. We still have industrial demand growing from solar, from EVs, from electronics. We still have investment demand that's been building for years. We still have central banks around the world holding massive amounts of debt that might need to be inflated away. None of that changed between 121 and 71. What changed was who could hold their positions and who got forced to sell. If history rhymes, and it usually does, this wasn't the end of the move. This was the reset before the next attempt. Every bull market has these shakeouts. Every major move higher gets interrupted by violent crashes that flush out leverage and reset sentiment. 2011 had multiple crashes before silver ultimately bottomed and started the next leg. 2020 had the March crash before the run to $30. This might be that moment for this cycle. Or it might not. I don't know. Nobody knows. But the pattern's there. The mechanics are observable. The divergence between paper and physical was real. And the snapback we're seeing is exactly what you'd expect when forced selling ends and shorts start covering. I'm not a financial advisor. This is not financial advice. I'm a guy who watches markets, who studies patterns, who tries to understand the mechanics underneath price action. You need to do your own research. You need to make your own decisions. You need to understand your own risk tolerance and your own time horizon. What makes sense for me might not make sense for you. What I'm watching might not be what you should watch. But if you understand the principles, if you understand how forced liquidation works, if you understand the difference between structural selling and fundamental selling, you're going to make better decisions regardless of what silver does next. If you made it this far, you're the type of person who wants to understand, not just react. You're the type of person who thinks critically, who questions narratives, who looks for observable data instead of just following the crowd. That mentality will serve you well. Not just in silver, in every market you ever touch. Because markets are driven by human behavior, by leverage, by fear and greed and forced actions. And if you can see those forces at work, if you can recognize the patterns, you've got an edge that most people will never have. If this breakdown helped you see what's actually happening, if it gave you a framework for watching silver going forward, do me a favor. Share this video. Send it to someone who's confused about what just happened, someone who panicked during the crash, someone who thinks markets are random. And subscribe because I'm going to keep breaking down these patterns as they develop. I'm going to keep showing you how to read market structure, how to spot forced selling, how to recognize when paper and physical diverge. This is just the beginning. Stay sharp out there, think critically, verify the data yourself, and make your own decisions.